Well, look who we have here. It's Ian Investor, the self-proclaimed guru of the investment world. The guy who's been flashing his cash and fancy cars on Instagram and pretending like he's got it all figured out. But now, he's about to embark on a ramen noodle diet, which is not a good sign, folks. Why, you ask? Because Ian learned the hard way that when it comes to taxes, the devil is in the details. Yep, taxes can be a real buzzkill for anyone, especially those who are not prepared. Poor Ian's rental property losses got out of control, and he ended up with a whopping $150,000 in losses. That's enough to make anyone lose their appetite. But wait, it gets worse. Because Ian's losses were too high to qualify for the active exception, he could only claim $25,000 in losses that he couldn't even use right away. And if that wasn't bad enough, the poor guy got hit with a massive $79,750 tax bill. Ouch. Now, if you're scratching your head, wondering how this could possibly affect your own investment business, let me break it down for you. When you own a rental property, you can usually deduct certain expenses, like mortgage interest and property taxes, from your income for tax purposes. But the IRS has limits on the amount of losses you can deduct if you're not an active participant in the rental property business. The good news is that there's a way to avoid Ian's nightmare. Yes, you heard me right. With the right entity classification and structure, you can deduct 100% of your investment losses. That means no more ramen noodle diets or heart-stopping tax bills. So, if your accountant stares at you like a deer caught in headlights when you mention this, it's time to reserve your spot in the TVIP lounge. Don't be like Ian, who thought he had it all figured out and ended up with a belly full of ramen noodles and a wallet that was lighter than a feather.